What's up, guys? Welcome to Stock Talk with Nico Criticos. Today we're going to be going over Twilio stock. This is a cloud-related software company that specializes in communications. So what this company does is they help other businesses communicate better with their customers. That means whether it's social media, whether it's email, whether it's text messaging, whatever it is, they are the middleman between businesses and their customers. So they're playing a very important role, and I think they are a very important business. Now, as for the performance of the stock, we're going to see in the last 5 years, the stock is only up 15%, and it's pretty much trading at the same price it was trading at 5 years ago. Now, in 2021, it traded all the way up to $435 a share, and now we're back down to only $60. If we're looking at what this company does for revenue-wise, we're going to be looking at the last year. They did about $3.8 billion. And they did 57% revenue growth. So they're growing, 57% revenue growth on average the last 5 years. So they're growing very fast. As for net income, it's not as nice there. We're looking at negative $1.2 billion. Their net income is consistently getting worse. As you're going to see on this graph right here, that's why this is what scares me away from the company. They've had about over a decade now of net income getting worse and worse every year. With last year, they did over negative $1.2 billion. So I don't like that. Of course, the P ratio is going to be negative, so that's going to get a no. I would consider this company innovative, though, right? They're a cloud software company, and they're doing something that really we haven't seen too much of in the past. So I would definitely consider them innovative. For market share, it's a little bit tough to judge because once again, they're kind of creating their own market, right? There's a couple other players doing similar things, but this is still something that's new to the market where there's not a ton of people doing this. Some people are still using older ways of communicating with their customers. So that's where Twilio comes in, and they kind of restructure the whole process. Now, one thing I will point out though is the fact that they are growing faster than the market as a whole, which the market is communication software. They're growing revenue at over 50% per year the last 5 years. So I think they are taking market share away, and that's definitely a good sign. Return on invested capital, of course, is going to be negative. Their equity, unfortunately, it was growing very, very fast compared to where it was, 3 years ago. I think they were at $4 billion of equity. Now they're sitting at about $10 billion of equity, but the problem here is you're going to see for over a year now, this equity of $10.3 billion has been decreasing. It was over $11 billion about a year and a half, 2 years ago, and now it's all the way down to 10.3. So that doesn't mean things can't turn around. Things can turn around, and maybe their balance sheet gets better. I don't want to say they have a bad balance sheet, though, because as you're going to see for this next thing on my criteria here, not only do they have a large amount of equity compared to their market cap, they have over $10 billion of equity, and the market cap right now is only $11 billion. So that's very good. You're getting 90% of the valuation in equity. The other thing I really like that you don't see with any other company that I analyze is the fact that their assets minus goodwill is 3 times their liabilities. Most companies out there, they're not even close to being double that. So 3 times is super good. Profit margin is negative, of course. Cash and receivables is more than income only because they don't have any income. They do not pay a dividend, and the company was founded in 2008, so they're not yet 20 years old. And then growing free cash flow. Once again, another thing similar to net income, it's a problem. Negative $330 million of free cash flow. So that's something they need to fix as well. So overall, I would say I really love the business model. I think they have a great future in the space that they're in. And I really love their value proposition, what they're offering to their customers. However, I am afraid of stocks that have these type of financials where they have, every year the net income is getting worse, right? I will applaud them for their balance sheet. It's in a pretty good spot. Even though the equity is coming down a little bit, their ratios of assets to liabilities are so strong. But the important things here are things like free cash flow, net income, profit margins, return on invested capital. And if all that's negative, the other thing I missed here is the number of shares. The number of shares is growing at 15% per year. That's another reason that this stock is going to fall. So I don't know. I'm not interested in buying yet just because of the financials, but if those were to improve, I would be interested.